Well, good morning, everybody. Thank you, the Swiss Mining Institute, for having Toqueville and myself speak to you today. I want to share with you a little bit about what the gold price says about financial markets, but also what the gold stocks are saying about the gold price. And what I want to do is touch on introduction to Toqueville at first. You may be somewhat familiar with Toqueville, but also then talk a little bit about the gold market and put it in a context. Highlight some of the fundamentals I think that are real positive for gold going forward in this cycle. And then talk a little bit about gold stocks and I think the valuation metrics that are really quite compelling for investors at this point where we find ourselves in the cycle. We do have the traditional disclaimer here that we're required to share with you, so please look at that. Toqueville Asset Management is a New York-based SEC-registered investment advisor. We've been around since 1985. We think of ourselves as contrarian, fundamental-driven investors. We have a disciplined investment approach. We try to mitigate risk with our in-depth research. We have a portfolio oversight approach to our investments. We have a long-term investment horizon. Our turnover in our funds is about 10 or 15%. So when we make an investment, we stick with it. We're looking for value creation over the long term. We assess the management teams that we're investing in. We look at the financials, certainly, but clearly the assets that we're investing in are important to us. Right now, we have about $10.5 billion under management. Of that 10.5, approximately $2 billion is invested in the gold mining sector. It is an employee-owned institution, so we have our own capital invested in our strategies. We do run mutual funds, separately managed accounts, private funds. Our gold strategy covers the spectrum in the sector from the junior explorers to the developers and the senior producers. The gold strategy assets under management right now are actually $2 billion. This $1.4 billion figure was as of the end of 2015. And year to date, we're up about 35, almost 40% in our investments. It represents a little bit more than 13% of the firm's assets, probably about 15% at this point. And you can see the composite returns over the years. We started the strategy back in 1998. I joined, as Eric mentioned, in 2003. John Hathaway started the strategy and clearly has had a lot of success with it. Just to kind of, I think, maybe point out the obvious for some folks, but I think it's perhaps appropriate to put it in context that, you know, on any given day, gold seeks price discovery. And what's interesting is that it takes a reference on price from a number of different things, and any different day it could be something unique. It could be commodities, it could be currencies, it could be inflation expectations, it could be interest rates, it could be market trends, it could be government policies, but I think bottom line, gold reflects financial anxiety. And I think that's the state we find ourselves in today, that there's a lot of financial anxiety in the marketplace, whether that's reflected through interest rates or through exchange rates. And I think if we look at gold, we try to ask ourselves, what is gold really telling us today? Is it the fears of higher interest rates or inflation, or is it reflecting a lack of confidence among investors in governments and central bank policies? And I think if we kind of break it down, we can recognize that as much as the U.S. Federal Reserve is trying to encourage markets to expect higher inflation as perhaps a reason to raise interest rates, they're having a lot of difficulty doing so. And certainly they're being countered by the ECB and the Bank of Japan, which is easing rates further. Unfortunately, this is causing a global interest rate divergence, and it's resulting in competitive currencies around the world. We're seeing devaluations across the board, whether it's here in Europe or in Asian markets or in African markets. Unfortunately, it's reinforcing an already crowded trade on the strong dollar against weak global currencies, which is exposed to excessive debt. And this has certainly increased financial anxiety, and I think that's the response you're seeing in the gold market since the end of last year, is there's a loss of confidence. And I think that's a point to underline, is that clearly investors have come to the conclusion that central banks are out of ammunition. You see that in parts of the world that there's really a war on cash. I think in Europe there's some discussion about doing away with the 500 euro note. There's discussion in the US about doing away with the $100 bill. I recently went to the Starbucks near my house in New York City, and I tried to buy a cup of coffee with a $50 bill. And I was told that they could not make change for me, that they would not take a $50 bill. And I was really rather upset because that's all I had. And I had to ask the manager to make change for me. Well, they did accommodate me. They did give me my coffee, my $2.50 coffee, and gave me change. Well, a week later, I went to the movies, and I had a $100 bill. And I wanted to buy 2 tickets, one for myself and my wife, and they weren't going to make change for me because they don't take a $100 bill. And ultimately, I did buy the tickets, but I used my credit card. So you can see there's something going on in the world where government is perhaps trying to suppress the use of cash. The encouragement is to use digital currency. Those are just 2 kind of examples. I think if you go to New York, you might find the same experience. I think what's rather interesting is that last year, as the gold price suffered, the markets were anticipating higher interest rates. And as you recall, going into December, there was a lot of commentary among the media and markets about the Federal Reserve raising interest rates. And ultimately, we did see an uptick in interest rates. But what's very interesting to note is that we've seen this picture before, where other countries around the world have raised rates. But ultimately, 18 to 24 months later, they've had to reduce rates. And I think if you recall back a couple months ago, a number of commentators were expecting that the Federal Reserve would be raising rates 4 times this year. Well, clearly we went through last week and we didn't see a rate increase, and now it's being deferred perhaps till June or even beyond our US election, maybe in the later part of the year. I think if we get 1 increase this year, that would be considered success for the Federal Reserve. But clearly the markets are doubting that interest rates are going up, and there's good reason to doubt that. Economic strength is not quite as strong as I think the Federal Reserve would like to see. There's the difficulty of the US markets being tied to international markets, and clearly the Federal Reserve is recognizing that. I think in substance, basically the Federal Reserve blinked about 2 weeks ago, and certainly that has encouraged gold investors. Here's something I want to share with you. John Hathaway wrote a paper, and I'd encourage you, if you have a chance, to go to our Toqueville website, toqueville.com, to take a look at his paper, Utopia of Alchemists. And in it, he pointed out that the notational gold paper trade is really quite significant. You can see on this chart that on a daily basis, there's about 3,000 tons equivalent of gold traded in the paper market. That compares to the supply of gold that's produced and available from mines and from recycling, which is about 10 tons. So there's about a 300 to 1 trade on paper gold in the marketplace. And these are trades that are done through financial instruments, whether it's futures or options or whatnot, around the world. And basically what traders are doing is they're trying to capture price differential. They're just looking for a trend, a gap of some sort where they can make some type of trade. They're not really looking for delivery. But you can only imagine if people started taking delivery, and we've seen some examples of that in the last several weeks, that there would not be enough gold to supply that delivery. I think about 2 or 3 weeks ago, BlackRock had to suspend issuance of new ETFs because it did not have gold to support its ETFs. Now, it does have a registered ETF, and those were able to continue trading, but for a period of several days, it did have to suspend issuing new ETFs because it did not have gold available. So there's a very interesting dynamic in the marketplace. I would suggest that John Hathaway's paper in early January really kind of triggered the gold spark in this market here year to date. Because I think just after that, you saw gold increase in late January, where investors began to realize that there was this dynamic in the marketplace where central banks are incapable of executing on their policies, that the gold market is very tight, and that there's a potential for a significant rise in the gold price. And why is the gold market tight? Well, you've seen this chart, I'm sure, as many of you are gold investors. You've seen that gold has really migrated to the east, to the Asian markets, whether it's Turkey, Russia, India, or China. Over the last 7 or 8 years, there's been a real steady progression. As much as the Western markets have maybe been disinterested in gold, we've really seen that march to the Asian markets, where gold is being held in a different form and is very unlikely to come back to the Western markets, even at higher prices. And I think something that's important to underline is that in the Western markets, there isn't the gold available that there used to be. If you go back about 4 years ago, you would see that in London, the London Bullion Market Exchange, is that the gold stored there has declined significantly. It's down about 30%. This is the central bank, this is the Bank of England's gold, but you can see that the LBMA's gold has decreased significantly over the last 4 or 5 years. And in just the last year, you can see it's gone from 2,000 tons to about 1.1 thousand tons, so it's been cut in half. So significant decline here. And I think another point to underline, you've seen this, I'm sure, is that a 1% increase in the allocation of gold would certainly swamp the amount of supply that's in the world. Right now, I think somebody else pointed out there's about a 0.5% allocation to gold relative to financial assets. If we increase that by 1%, that would require about 56,000 tons of gold, which is about a third of all the gold that's ever been produced. Actually, it's probably a little bit less than a third of all the gold that's ever been produced. But clearly, gold prices would have to rise to meet that allocation. Now I want to shift a little bit and talk about gold stocks. You know, some of these points are certainly obvious to you. You heard this morning. But I want to emphasize a few aspects, and it's the way we're thinking about gold stocks at Toqueville. They offer optionality to the gold price. And what is that optionality? It's not just participating with the gold price directly, but it's through a number of different means, whether that's value creation through discovery. A number of companies presenting today are discoverers, and they have made some discoveries, and they're certainly showing value creation through that process. But there's asset value leverage. As a gold deposit is identified, and as the gold price rises, the marginal ores become more valuable. So there's a significant value creation, not just from discovery, but from price appreciation as the gold price rises. There's price margin leverage. If costs remain the same, for a producer, the rise in the gold price certainly adds to profits. As those profits increase, there's potential for growth as that asset base gets larger from higher prices. And certainly expanding an operation on a marginal basis can be very lucrative and provide good returns of capital. And certainly there's financial leverage in the sector. We've seen that over the last number of years. And as you know, there's a lot of M&A activity. The structure of the industry is such that there's a lot of explorers, there's developers, there's producers. They all are trying to replace the resource that they're diminishing. And I want to spend a little time with this chart because I think the past is somewhat telling for the future in the current marketplace. If you look at a gold stock and you think about it as the cumulative future cash flows that are generated from the assets, you could infer something about the gold price. And if we go back in time to, I believe this is 2009, the black line reflects the price that gold stocks were implying that the gold price would be. And you can see that as much as the gold price, Oh, I'm going the wrong way. Sorry, folks. Here. As much as the gold price rose to about $1,900 an ounce, gold stocks never reached that height. They reached about $1,550 twice in 2011, 2012. And in fact, they separated from the move in the gold price back in 2010, 2011. The gold price was forecasting that, the gold stocks were forecasting that the gold price would not go higher. In fact, I think the gold stocks were correctly anticipating that the gold price would decline, even though the gold stocks rose into 2012 and in 2013. And you can see that back in 2012, as Japan was selling, restructuring its financial base, the gold price sold off significantly. What's interesting is that over the last couple of years, the gold price has come down, but the gold stocks have not come down as much as they would imply the gold price should come down. And you can see more recently that the gold stocks have risen significantly, implying higher gold prices. Gold stocks are often thought of as forward-looking to the gold price. And it looks like in this marketplace that we are seeing a resurgence in the gold stocks. Obviously, they've risen 35 to 40%. However, they have not implied a higher gold price as strong as we've seen in the past. There's probably another 15 to 20% move in these gold stocks just to get to a gold price equivalent of where we were about a year ago. And what are the gold stocks saying about the gold price now? Well, what's kind of interesting is that the 10-year average of the gold price was about $10.85. And that's approximately the full cost of production. And by full cost of production, I mean all the cost to produce gold on a corporate basis. That includes the interest expense, that includes taxes, royalties, the operating costs, the G&A costs. The gold price got down to, what, $10.50 or so last year, almost equivalent to $10.85. And it seems like that's the industry's cost of production, $10.50 to $1,100 an ounce. So it appears that the gold price has reached the bottom. I think a lot of people are wondering, is it going lower? Potentially it could go lower, but clearly the market has observed that we're at the break-even level, that we reached the break-even level last year. And certainly the industry has consolidated, and we've seen a reduction in long-term investment. Over the next several years, I think a number of speakers have indicated that we're going to see a reduction in supply. Certainly that is supportive for higher gold prices in the long term. And I would say that even though gold stocks have done well, I repeat that they're reluctantly rising. I mean, granted, gold stocks are up 35, 40% year to date, but they are not quite anticipating as high gold prices as they did 5 or 6 years ago. Right now, they seem to be anticipating a gold price of about $1,300 an ounce. At $1,300 an ounce, you don't replace old supply. It doesn't justify new production at $1,300 an ounce. We probably need about $1,550 to $1,600 an ounce to justify new production. And it appears that the reason gold stocks aren't going higher is because investors are very concerned and fearful that companies are going to misallocate capital. That was a big concern over the last 4 or 5 years, that management teams were not using their capital efficiently, that costs were out of line. And it appears currently that investors are very reluctant and very selective in terms of their investments in the gold sector. And that continued loss of confidence, I think, is going to be reinforced as we go through the year, as investors recognize that our institutions are broken, that alternatives are sought for relative to financial markets, creating a very good environment for gold over the longer term. In terms of valuations, I think it's very interesting right now that it is more compelling for either mining companies or investors to look at the sector and recognize that valuations favor buying mines as opposed to building mines. Recall I just said that we probably need a price of about $1,550 to $1,600 to justify new production. Right now in the marketplace, you can see that you could actually go in the market and buy producing assets for about the same price to build new assets. So before you would commit new capital and go along the long-term horizon of permitting and developing a new project, you're probably better off buying a producing asset. And we've seen over the last several weeks a number of acquisitions, whether it's producing operations such as Lakeshore Gold or potential projects. The marketplace has become very, very attractive for larger companies to acquire assets as opposed to build, which I think is an important signal for investors who are not directly involved in the space to recognize that this sector has bottomed out. I think further to that point is that the valuations are very compelling. If we look at a long-term chart here on your left, you'll see that the price to cash flow is at an all-time low. This sector has really been forgotten. Granted, this is a well-attended audience today. You're somewhat informed, I'm sure, about the sector, but there's a lot of investors that have really dismissed the space. And I think this is an important point, and that is that as much as the mining industry in general, whether it's copper, coal, nickel, iron ore, has suffered over the last year or so, the gold sector has been in a downturn for the last 3 or 4 years. And generally speaking, the gold sector leads other mining sectors. So the gold sector, in a regard, has paid its price for the excesses of the last cycle. And we're beginning to formulate a new cycle in this current environment. Further justifying those low valuations, you can see on the right, that's the adjusted market cap per ounce divided by the gold price. Here too, we're at a multi-year low. This chart goes back to, I believe, 1985. So you can see that in the last 30 years, this is the lowest valuation we've ever seen. And you know, there's no new real projects. Now you're hearing about some projects today, but these are projects that have been in the formation for the last 4 or 5 years. To initiate a project, it's going to take 5, 7, 10 years to bring that production to the marketplace. We're going to go through a gap in production in about 3 or 4 years, which is going to be very encouraging for gold price and for the gold price, which I think is a very, very important element for investors to recognize. And finally, I want to leave you with this chart. Gold has a seasonal aspect to it. It's kind of curious. This depicts the last 11-year trading range relative to the average gold price. And you can see that early in the year, the gold price is relatively weak to the latter part of the year. Even though we've had a 20% increase in the gold price year to date, generally speaking, the first 4 or 5 months of the year sees the weakest part of the gold price for the year. Gold prices start out strong in the beginning of the year in January and February as the Asian markets buy gold. There's the Chinese New Year, there's the Indian holidays. In June, July, August, gold is generally weak as investors lose interest. As we get into later August, September, October, investors become more enthusiastic as Western markets buy gold again. And you can see that this is a pattern that has repeated itself over the last 10 or 11 years. You know, I point this out to you because I think there's an opportunity for investors to participate. Even though the gold price has run 20% year to date, there's a good opportunity over the next several months to build a position in gold. And if you're a trader, to trade out later part of the year. We're not traders. As I mentioned earlier, we invest over the long term. But I think it's a good observation for investors not familiar with the space to recognize there's a long-term opportunity as well as a short-term trading opportunity. And with that, I do have our composite performance. I'll share that with you here. I think it's probably in the profiles that are being shared with all of you. I'm not going to go through all the numbers, but with that, I'm happy to take questions or comments.
Okay, well, thank you very much. We're just running out of time, so if you're
Thank
gonna
you.
take questions after the
All right.
session,
Thanks,
we
Clint.
can, but thank you again, and
Thank you.
I invite everybody here in the audience to have a very close look at their performance
Very good presentation.
in the last cycle where they've outperformed massively. Thank you.